Good morning, friends. If you want to achieve financial freedom, you have to understand various type of risk which you may encounter in your journey of financial freedom. Friend, I am Ramchandra and you are watching Prayas, a channel which is your partner in developing your personality. Friend, we are discussing financial freedom. I started this video series from PD 78 and this is PD 86. In the first video I discussed what you have to do if you want to become financially free even before attaining the age of 35. In the second video I have discussed what 5 things you should understand before you can invest. In the third video I have discussed what is the magic of compounding. In the next video I have discussed dynamics of money one must understand. In the next video I have discussed various investment options which you can try. And then I have discussed the safety net of fixed deposit. And then I have discussed investment in business. And after that, I have discussed danger of investing in equity shares. In the last video, I promised you that I am going to discuss now mutual funds, which is a very popular mode of investment today. But I thought that one concept which has not been discussed in detail must be discussed before I start discussion on mutual fund. That concept I have already listed in my second video, that is what 5 things you should know before investing, and that concept is risk management. How you can manage risk which may encounter in the journey of your investment and financial freedom. Friend, I request you to be with me throughout this video, because at the end of the video I am going to indicate the maximum level of risk taken by a group of investors and how they manage it, so that you can have an idea that what can be the extent of risk and what can be done to manage that. Friend, before I start discussion on this very important topic, I must inform you that I hold live sessions, have a discussion forum, direct personality development program, and your economic condition will not become a hurdle. For detail, you can go to description box, click certain links, see the content, visit our website, consult the content available there, and then you can decide what type of help you can take from me. I am always there to help you. Friend, if in case you find that this video has got some substance, please like it, share it, and subscribe to this channel if you have not done so far, so that you can get useful video every week. Now friend, let us discuss the concept of risk. What is risk? You go on road, you are walking on road and a vehicle comes from behind and hit you. You can be injured, you can have fracture. So this is a type of accident you have not visualized. It is the risk of walking on road. Even the worst can happen, a death can happen. How do you manage this risk? You can't eliminate the risk because you are going on the road. Of course, you should be careful while walking on road, but even then, the other fellow can commit a mistake. So if you have got accident, And if you have taken accident cover insurance, the expenditure part will be taken care of by the insurance company. And in case of death, if you have taken life cover, life insurance, your family will get adequate compensation and their future will be protected. Now in the second video, I have given you an example of a atta chakki, flour mill. I said that since the risk is very low, the reward is also very low. And if you manufacture drug, pharmaceuticals, formulations, your risk is more and reward is also very high. Also, the risk-taking ability is also not same in every individual. If you are young, you have just started your job, you have a very long life to earn, then you are in a condition to take more risk. You can experiment and you can sustain some loss also. But I cannot expect same thing from a senior citizen who has retired and have got hard-earned money which has got after retirement, settlement dues. So he will not take any gamble with it. It will invest it very safely, either in debt or in a hybrid fund or whatever, because he cannot afford to lose money. So risk-taking capability also varies with age. The risk-taking capacity also depends upon your financial status. If there is a very poor family who has got daily wage earning and they have no property to fall back, they have got a small hut, they cannot take any risk. So they have to be protected by government through various insurance schemes, etc., etc. And they cannot invest their money in risky options. They have to go for bank deposits. As I told in the previous video, that video related to fixed deposit, that they can invest up to 5 lakhs in one bank, one account, and that is totally safe, insured. They can open a RD and they will be safe. But if there is a family, higher middle class family which has got good earning, good property, they perhaps can take risk. They can put their money in equity share also. They can put equity mutual fund also. So they can undertake that risk because their risk-taking ability is much better. Also, the knowledge also equips you to take more risk because you are aware about it and take adequate safeguards. So, level of awareness is also very important. You should know about the risk management technique so you can take risk knowingly in full awareness. Now friend, one very important concept of risk management is the concept of diversification. I will give you one example. Suppose you have invested money in Tata Motors. You have bought their equity shares. In past they were giving a stable dividend. Appreciation was also reasonable. But all of a sudden, because of change in policy and the market condition, their sale goes down, profitability goes down, and then you are not able to earn adequate return, rather you have a depreciating value of your investment. Why it has happened? Because you have put all your egg in one basket. You have put all your money in Tata Motor. But if you would have invested your money in 5 or 6 companies working in different domains, having different prospects, the chances of such a large scale loss would have been avoided. Because maybe Tata Motor has not performed so well, but other 4 could have performed. You can spread it even up to 10 companies. So diversification helps, in managing risk of investment return. This is not true only in case of investment, it is also true in case of business. There could be a business risk. Suppose there is a company who is selling some product in only US market. There is no other market. Full dependence on US market. And Mr. Trump has imposed 50% duty on that product. Now that would be a problem. They can't export because of that. They become non-competitive. So they are going to lose very, very heavily. And if you are an investor in that company, perhaps you will also lose. But if this company would have 10 markets, 10 countries, export market and domestic also, and if the share of US market was only 2%, so even if he cannot export to US, 2% only loss will be there in its sale, export earning. Or it can compensate that by increasing in other markets. So it has diversified the market. So risk will be minimized. Same thing can happen to the customer side. You can have different customer sector, or you could depend upon one segment only. If something happens to that segment, you are exposing to your very, very serious type of risk. So diversification works whether in investment side, whether in business side or other side. There could be a currency risk. Suppose the value of money is falling every day. So that is another risk you are. Suppose you have taken foreign loan. The value of loan will, in rupee term, will go on increasing because rupee is depreciating. So that is another risk. So there are various type of risk and there is various strategies to manage risk. So far investment is concerned, diversification works very well. It protects you from very volatile type of fluctuations in your earning from investment. Now, I promise you that I will share you with the information that who takes maximum risk in the area of investment and how it manages. Friend, the most serious type of risk is taken by venture capitalists. What they do? They invest in the equity shares of just promoted companies which have no past record. What they do, how they manage their risk. Number one, since there is no past record, they are going to analyze the idea put up by the entrepreneur, startup founder, in great depth and try to ascertain whether this idea is likely to work or not work, depending on market condition. They are going to examine the profitability estimates very, very objectively. They are going to analyze the entrepreneurial profile very, very diligently. And after in-depth due diligence only, they are going to invest. So, if in the normal fashion, 9 out of 10 units fail, in their scenario, this ratio will be not so bad. Maybe 3 enterprises fail out of 10. So, they invest their money in a diversified form, let us say in 10 enterprises which are newly established. So maybe 2 or 3 units may fail also finally. So they lose their capital there. But they earn very heavy return in other 7. So on the whole, they are able to earn a reasonable rate of return of 20, 25, 30%. Even after taking such a high level of risk. How they are able to manage it? The first thing, in-depth analysis and generating awareness about the future of such a industry. And second, diversification. So these two things, awareness plus diversification works in their favor and they are able to manage this type of risk. But if you are an investor, if you want to invest in equity share, as I discussed in the last video, you are going to invest in a company which are stabilized has grown up to a level, has become eligible for listing in the stock exchange. They have a history, they have a known future up to some extent. So you are taking much less risk than a venture capitalist who is investing in a company about which nobody knows. There is no past record. Nobody can say what will happen in future. So he is doing his homework, then he is investing. So if you also do your homework diligently, your risk will be much less than what he is taking. And mutual fund is one area where diversification is automatic. Therefore, friend, you must be careful in understanding the type of risk you are likely to take. Take suitable measure to manage it and then invest. So in all probability, you will attain financial freedom at the earliest. And if you ignore risk, then perhaps you may not achieve your target of financial freedom. Friend, I am thankful to you that you have given so much time to me. Before parting, I want to request you that health is wealth. Please take care of your health. Then only you will succeed as a person in whatever field you are doing, whatever work you are doing. You will increase your earning, you will do prudent investment, and you will become financially free. Friend, thank you very much for giving me so much time. I am sure that you are going to share and like this video and subscribe to this channel if you have not done so far. Thank you very much.